All right, we are looking at futures gaining 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, data dependence. We're going to get the latest JOLTS and consumer confidence data as the Fed meeting gets underway.
And Microsoft kicks off this week's Mag 7 earnings. The scrutiny is high after Alphabet and Tesla disappointed last week.
And the drama over at Pershing Square. A major investor opts out of Bill Ackman's upcoming fund IPO. We're going to get to all of that, but let's take a look at where markets are trading 30 minutes until the cash open. As Matt mentioned, you have futures higher right now. The S&P 500 up about 0.2%. Even more so if you take a look at the NASDAQ 100 up 0.3% ahead of a very important day, a very important week. Take a look at the bond market. It's pretty quiet right now, the 10-year Treasury yield. I'm going to go ahead and call that unchanged, Matt.
All right, take a look at the labor market cooling. It has spread beyond California. These are Sunbelt in white here. Sunbelt states, which is pretty much the entire lower half of the country, ex-California, starting to rise. They're warn notices. So this is what big companies have to file with the BLS when they're about to fire a large amount of people, lay off a large amount of people, and they're starting to climb. Maybe that SOM rule gets met sooner than we think.
Some green on the screen before the market opens. Of course, SoFi raised its forecast for the second time this year as it benefit from new tech businesses and its lending operation. SoFi shares up more than 3.4% and the greatest volume of shares traded for any company this morning, over the tune of $5 billion. Tune in for our interview in the next hour with SoFi CEO Anthony Noto at 10:30 a.m. Eastern.
All right, we have a lot going on in terms of earnings. Some misses that are actually being punished. I'm thinking about Procter & Gamble, for example, even though yesterday we saw McDonald's with a miss that was somehow rewarded.
Yeah, it really speaks to how you can't paint this market with one brush right now. There's a lot of idiosyncrasies. I hope I said that right. Anyway, there's a lot of nuances right now that you need to look at with each company. And, I mean, we're skating into the big boys. Of course, Microsoft coming up after the bell.
Totally the big boys, and it's interesting, too. We have some airlines as well, JetBlue. We're going to talk all about it this hour.
All right, well, it is a busy week ahead, full of central bank decisions as well. We have economic data and, of course, big tech earnings. Joining us now to break it all down is Ross Mayfield. He is investment strategist over at Baird. So let's start with the fact that we finally get some tech earnings to talk about. Microsoft after the bell. If you think about that in the context of the past few weeks, this rotation trade that we're seeing, do you think that we're going to see big tech really reestablish itself here?
I think it's possible, at least remind investors that things aren't all that dour. These companies are still, highly leveraged to AI, printing money, investing aggressively. So I think it'll be a reminder of why you own these businesses in the first place. With that said, the burden is a little bit off some of these companies to deliver outstanding results and pull the market up higher, because you're getting support from small caps, from energy and industrials and financials. So there is a little bit less pressure on the earnings, although the market, remains historically concentrated here.
Aren't we priced to perfection in a lot of places? I mean, the miss that we see at P&G, it makes sense to me that it's off. Yesterday, McDonald's closed up, even though it posted the first quarterly sales contraction that it's seen since 2020.
Yeah, I mean, as was mentioned at the top here, it's a market of idiosyncrasies, of wide dispersion amongst individual names. We're mid-cycle. You would expect that. It's no longer a rising tide lifts all boats. You've got a slowing consumer, a cooling labor market, as you mentioned. The Fed is talking about cutting, but rates are still in restrictive territory. So it's going to be a lot more about individual stories, about profit margin protection in this kind of environment, because top line growth is slowing. And so I do think you're going to see a wide dispersion of individual performance. And because estimates didn't come down very much, you will see more punishment on slight misses or even beats that don't kind of meet market expectations.
Where does the rubber hit the road when it comes to the consumer, Ross? You looked at McDonald's. You had some investors really shaking off the worries there. You have Starbucks after market today and a clear weakening of the consumer. Where does that play through into the market?
Yeah, it's tricky. We talk about the consumer as this kind of big aggregate thing, right? But there's really a bifurcation that's going on where lower income individuals are struggling with inflation, are struggling with higher rents, are struggling with wage growth cooling a little bit. Where higher income individuals, who do a majority of the spending, are seeing excess income from, high yield savings, are seeing home equity, or have not, felt the pain of higher home prices because they have their mortgage locked in. And so there's a bit of a bifurcation in where that consumer spending is happening. So you're seeing some of, the quick service restaurants talk about value, pitch value, but then you're seeing things at the higher end, do okay. So it's really not one consumer, I guess, is the point, and it's a bit more split than we talk about it as.
So what happens to the middle, and when you went to the middle, and when you put that together into a portfolio, I mean, how does that inform where actually you invest right now at a sector level?
Yeah, it's a great question. Less than a sector level, we're thinking more about kind of the factor tilts of a portfolio. And one of the main themes that we're talking to folks about is right now, even if the Fed is to cut 6 times in the next year, which is where the market is pricing right now, you've still got rates well above the high water mark from the prior decade. You've still got rates in restrictive territory. Quality, profit margin protection, prudent management. These are the kind of things that I think, even as you're seeing kind of lower quality small caps rally here, these are the kind of things that are going to win over the full cycle, in addition to secular growth themes like AI, because you just have a much higher bar to clear in the form of higher rates, of higher and more volatile rates and inflation. And so we're looking to quality companies, sector neutral, as something that'll win not just this year, but over the course of the cycle here.
Ross, if I look at a lot of labor data, we were just looking at WARN notices, for example, in the Rust Belt, in the Sun Belt, in California, they continue to climb. It's a little bit worrying that we could hit the SOM rule, a rise in unemployment of 50 basis points in the 3-month average sooner than the Fed cuts. Is there any chance you think that the Fed cuts sooner? Could we get a cut tomorrow?
I don't think so, but I do think that the Fed can and should be aggressive with their guidance and their language. They can do a lot of the work of a rate cut, just with their words. And so I think if they come out with a strong message that they do see a more balanced risk profile, obviously inflation is not back down to 2%, but they have a dual mandate and the labor market is clearly cooling to a point of concern, as you mentioned. You can look at a bunch of different indicators and see the same story. So I think they should come out pretty aggressively, and hint or even guide to a cut in September. And talk about the two-sided risk, because it really is growing. And to the extent the consumer has carried the economy, that labor market is more important than it's ever been.
Is one cut enough, Ross? If you take a look at market expectations, they're obviously expecting multiple into next year. Does the market need to see that much cooling of interest rates in order to keep the heights that we're at?
I think so. I mean, I think again, the market is priced for 6 cuts by the July 2025 meeting. That obviously keeps rates in restrictive territory, but it's meaningful in terms of the feed through to something like mortgage rates or to corporate borrowing levels. The market is priced for that. I think the Fed needs to probably deliver on that, or I think the market gives back some gains. We saw coming into 2024, that was the story, right? An aggressively priced rate cut path. The Fed didn't quite deliver on that, and the market stayed afloat because of the AI trade, but really underneath the surface, the market was reflecting some angst over the fewer rate cuts that were being priced in. If that were to happen today, I'd expect more market volatility and weakness. I think the Fed needs to deliver on market expectations for, 5+ rate cuts in the next 12 months.
All right, Ross, great to speak with you. Appreciate you helping us kick off the program. That is Ross Mayfield. He is investment strategist over at Baird. Now, we do want to bring you some breaking news on, of course, Pershing Square. Bill Ackman's planned IPO for a U.S. closed fund expected to bring in $2 billion. That's not the $25 billion that was originally penciled in there.
That's not even the $4 billion that was in his letter.
No.
I mean, it keeps getting smaller and smaller and smaller. It seems like there's no demand for this. Or I should say little demand, right?
Exactly,
$2 billion is still
$2 billion
substantial.
of demand, potentially less than a tenth of what he initially aimed for.
And we did get some details on pricing as well. It's expected to price on August 5th after the close. That's according to a term sheet that was seen by Bloomberg News. That could mean, of course, it starts trading the next day on the New York Stock Exchange. We know that Bill Ackman sent a letter to investors on July 24th, of course, just one detail in this very quickly moving story here.
And we've reported here, we'll talk more about it later, Baupost, one initial large anchor investor, dropped out. It's going to rely heavily on retail interest. His millions of Twitter followers here showing up potentially. Remember, SoFi is actually an underwriter on this deal.
That's essentially what his letter said. It was intended initially to go to big investors only, and he was saying to them essentially, get in on this now, because retail investors are going to pile into it after the IPO, and then you'll make a mint. But it seems like a lot of them aren't getting in on it now. Still, you can count on, I guess, his Twitter followers not to be watching financial news and to buy into it anyway.
Well, of course, we're going to talk about all of this later on in the hour. But again, just to read that headline again, that is Bill Ackman's planned IPO of that U.S. closed fund, expected to bring in $2 billion, expected to price on August 5th after the close. Meanwhile, let's get a check on the stocks moving ahead of the opening bell. We're going to do that with Abigail Doolittle.
Lots of earnings movers to take a look at this morning, Katie. Starting off with the shares of PayPal, they're up more than 7%. This after the payment company did put up a very solid, in fact, massive adjusted earnings beat. They also beat sales. They boosted the profit outlook solidly. The company really focusing on efficiency and streamlining. As for Procter & Gamble, it's a different story. They missed on sales. This stock is lower on this sales miss, and this is amid slower price increases. The organic sales rate for Procter & Gamble, the slowest in 6 years, may be a sign of what consumers are willing to tolerate. And then let's take a look at the healthcare space, because Pfizer, well, they boosted their profit outlook. Barclays saying it was more than expected, and there is still more room to come. On the other hand, Eli Lilly here, you can see up 1.3%. This has to do with Novo Nordisk's Alzheimer's drug. It yielded mixed results. What's so interesting, because of course Eli Lilly and Novo Nordisk competing around weight loss drugs, so it seems as though that bad news for Novo Nordisk on an entirely different treatment while helping out Lilly. And then finally, Matt, returning to earnings, Merck down nearly 4%. They beat and boosted similar to Pfizer, but the outlook considered not quite good enough by analysts, given the fact that the stock is up nearly 20% year to date into today.
All right, there's so much going on. Abigail Doolittle, thanks for rounding up some of those stocks. Coming up, Microsoft is the first of the Mag 7 to report this week, with investors looking for justification into billions of dollars spent on artificial intelligence. When will we see a return on that investment? This is Bloomberg. All right, let's get to high interest. We'll look at what's making headlines around the world. Protests have erupted in Venezuela as thousands take to the streets of Caracas to protest what they say is President Maduro's fraudulent win. Venezuela's opposition leader claims her party can prove that the incumbent lost by an irreversible margin. The U.S. and many Latin American nations are calling for transparency of the vote tally. We'll see if they do any more than that. The euro area economy grew more than expected in the second quarter thanks to resilient expansion in key countries, which allowed the region to shrug off a surprise contraction from Germany. The uneven growth outcomes across the region showcase the challenges faced by the ECB as it weighs whether another interest rate cut is justified in September. And Paris Olympic Games organizers postponed the men's triathlon to Wednesday morning due to insufficient water quality levels in the Seine River. It's too dirty. The delay to one of the game's flagship events came when athletes were already at breakfast, leading to some anger and disappointment, as you can imagine.
Well, meanwhile, yesterday, NVIDIA CEO Jensen Huang interviewed Meta CEO Mark Zuckerberg at a conference in Colorado. He asked Zuck about his vision for the AI ecosystem.
I don't think that there's just going to be like one AI model, right? I mean, this is something that some of the other companies in the industry, they're like, you know, it's like they're building like one central agent, and yeah, we'll have the Meta AI assistant that you can use, but a lot of our vision is that we want to empower all the people who use our products to basically create agents for themselves. So whether that's, you know, all the many millions of creators that are on the platform, or, you know, hundreds of millions of small businesses.
And of course, one of the companies that has poured money into AI is Microsoft, which reports earnings after the bell with a focus on cloud growth and AI spend. Bloomberg Technology co-host Ed Ludlow is here in person to discuss. And I guess when it comes to Microsoft, a ton of scrutiny on that Gen AI monetization.
Yeah, this earnings season, I think we call it the AI money machine, right? So everyone's putting money into the money machine. You know, $1 of infrastructure spend. Microsoft's kind of a leading example of that, where CapEx guidance is it will climb by about $2 billion in the quarter. How much money's coming out? And last quarter, they gave us a sense of that. So the cloud unit, where the AI activity is centered around, had in excess of 30% top line growth year on year. And they said 7% of that contribution came from AI. And so you either take that number and say, oh, that's good evidence, or you don't. And after Alphabet last week, investors are kind of reserving the right to be disappointed that there's not something more tangible.
If I look at the SPLC, which is one of my favorite functions on the Bloomberg supply chain for Microsoft, sure. I see that NVIDIA gets almost 20% of its revenue from Microsoft. Can this be true?
I love the Bloomberg terminal, and I love SPLC. I don't know if the math is as concise as that, but this is the NVIDIA story. You guys showed the soundbite of Zuckerberg on stage, right? Right now, NVIDIA's business is the 3 hyperscalers, Microsoft Azure being the number 2 player, AWS from Amazon, and GCP, Google Cloud Platform, a distant third. And then Meta is its next biggest customer. So revenue doubled last year. It will probably double again this year for NVIDIA. And it's the hyperscalers that account for all of that, including a big chunk from Microsoft, who has its own silicon ambitions, along with AWS, as you guys know. What they want to tell us, their earnings, August 28th, is it's so much more than that, guys. There's AI for everyone, and we found out how we're going to sell it. But their fortunes are very closely tied, which is why. Look at the CapEx number, look at the commentary about the spend going forward, and then in after hours, check your NVIDIA ticker.
It is alluring.
For Microsoft, I mean, yeah.
Yeah, absolutely. It is alluring to try to look at NVIDIA. But I also am wondering, I realize this is the sideshow, but because it did create a global outage, I'm curious about how Microsoft may address the CrowdStrike issue.
Yeah, this is how you should look at it. It was 1% of Windows PCs around the world, 8.5 million units. But CrowdStrike software is quite expensive. It's about $50 per PC, which if you're an organization that does something important, for example, an airline, it's likely it's your most important computers that had CrowdStrike installed. So the association effect is interesting, and Microsoft have commented a lot about the restoration of systems. What's more interesting is that CrowdStrike is probably the number 2 player in endpoint security in a market where Microsoft's number 1. And so they might go from being frenemies to Microsoft saying, yes, I think we might do things a bit differently in this market going forward.
And of course, CrowdStrike shares down about 4% pre-marked. Of course, the news overnight was that Delta is seeking compensation. Exactly. Right. Let's look ahead to, though, once we get past Microsoft, I mean, the earnings party continues. We have Amazon, Apple, et cetera. What are you expecting when you talk to your sources, investors, analysts, et cetera?
I think for a lot of investors, it's still the money machine. I know that's kind of a silly example, but that's the math they're trying to do.
You want to get money out of the money machine.
Particularly because look at valuations right now. You know, like you look at a chart of blended forward EPS for those Mag 7 names, and it's just going up at a 45-degree angle, and that cannot go on forever. They want to see top and bottom line growth directly attributable to artificial intelligence and the spend. Amazon's the most interesting for me. Go back to Alphabet. They were talking up AI. Everything is fantastical. We're spending money. We're making money. Search was still the biggest contributor to growth. What's old is new, and what's new is old. And I think Amazon will probably tell us a pretty similar story. AWS growth, but also look at advertising on the e-commerce platform.
I want to ask quickly about Tesla. Much has been made of an analyst's near crash. William Stein from Truist said he almost had an accident at an intersection using the full self-driving capabilities. I don't understand why this is such a big deal, considering the fact that there are already robo-taxis operating in San Francisco. They don't crash all the time, do they?
He got a lot of criticism from the Tesla hardcore fans because he used version 12.3.6. There is a newer version out, but it doesn't matter. His point was Musk said in Q1 and Q2, judge us on our ability to solve autonomy by going out and using FSD yourself. This Truist analyst did. He did it in April. He did it again more recently in the past week. And what he's saying is, I cannot yet see the jump. Based on the performance of the generations of FSD he used, I don't understand how you go from a consumer car that partly or partially drives itself to a robo-taxi fleet operated by Tesla. He's just taking what Musk said on the calls and saying, okay, I will do that test.
But other companies, Waymo and Cruise potentially, are already operating robo-taxis that don't crash all the time.
And this is why technology is important on this network. they don't use camera-only systems. They use a blended sensor suite of LiDAR and radar.
Ed, we got to leave it there. Thank you so very much. That is Bloomberg Technology host Ed Ludlow. And coming up, we're going to take a look at the companies making the most buzz on social media. Social climbers, that's up next. This is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on the futures here. We're looking at gains of about 0.25% on the S&P, a little more than 1/3% on the NASDAQ. The Russell 2000 small caps gaining almost 0.5%. Katie?
All right, that rotation, maybe it's coming back. But in any case, it's time now for social climbers. The companies making waves this morning. And first up, CrowdStrike in the crosshairs. Delta Airlines reportedly hiring an attorney to seek potential damages from the cybersecurity company and Microsoft following the widespread outage earlier this month that is said to cost Delta up to $500 million. Next up, score one for oat milk. Sprouts Farmers Market boosting its full-year projections for sales and profits after a stronger than anticipated second quarter. Now, the organic food retailer says that people are sticking with their diets despite higher food prices. And finally, a $3 billion unwind. Berkshire Hathaway cuts its stake in Bank of America for the third time just this month. Now, this move marks Warren Buffett's biggest pullback from a bet that has been a strong vote of confidence for Bank of America CEO Brian Moynihan. And Sonali, that one definitely caught my eye.
Yeah, it's been interesting because, of course, there have been multiple sales, Katie, but it's interesting because Berkshire still, Matt, holds about $40 billion worth of Bank of America stock. So nothing to cry home about. Still a very large shareholder. Remember, Bank of America has actually risen more than 22% this year, so we can call it some profit taking.
Right.
There you go.
He said Bank of America is an investment that you can keep. So, but he's
you want to hear a fun fact about Bank of America? So they roll off all of these bonds that they bought at, a very significantly high yield. They were not a great investment. It weighed on the stock. Now they're reinvesting them as interest rates fall. And so the same thing that got them into trouble the last couple of years is the same thing that's making them a great investment now.
That is a fun fact.
Isn't it?
Yeah.
Some bond math.
Not as fun as oat milk.
That's true.
How can it be called milk?
I don't know.
How did you even get
milk
there?
from oats,
It's
right?
a lot of big questions that needed answering. Let's talk to it about Margie Patel. She's from Allspring. She's going to be joining us next. This is Bloomberg.
All right, after a pretty lackluster end to the session yesterday, we're looking at futures that are up a little bit more today. 20 seconds until the opening bell. I'm Matt Miller. This is Bloomberg Open Interest. You can see that S&P futures are up 0.25%, NASDAQ futures up 0.4%, Russell futures as well. But remember, the Russell 2000 dropped more than 1% in yesterday's session. There you hear the bell on the New York Stock Exchange and on the NASDAQ. Let's get over to Katie Greifeld right now to see what's going on in the first seconds of trade. Katie, what do you see?
Just about 6 seconds since the bell rang, you can see again we're green across the screen right now. The S&P 500 up about 0.3%. Big tech up about 0.2%. The Russell 2000 a slight lead right now, but we're talking very slight. The small caps up about 0.4%. A little bit more action if you look under the hood. Let's take a look at Procter & Gamble. Sales missing analyst estimates as it slows the pace of its price increases. You can see that translates into about a 5% drop for shares right now, Sonali.
Also keeping an eye, Katie, on the pharma industry because there is divergence. Merck is falling as the drug maker's profit and sales outlook underwhelm. Meanwhile, Pfizer is on the rise after boosting its profit forecast. Pfizer only up about 0.8%. Merck now down more than 3.3%.
All right, PayPal is also lifting its profit forecast as the company remains focused on streamlining operations. Let's take a closer look at PayPal stock with Bloomberg's Abigail Doolittle. Abby?
Well, on this, Matt, we do have the shares of PayPal popping by more than 8%, up more than in the pre-market, heading to the best day of the year since November of 2023. So a great quarter. As you mentioned, they boosted the profit outlook, really focusing in on efficiency. But it's not just PayPal as a payment company that's doing well today. Take a look at Affirm Holdings, the pay over time time company. These shares up more than 5%, the best day in a couple of weeks. This after B of A raises their rating to a buy on profitability optimism, saying that a firm can achieve profitability by 2026. Relative to PayPal, one thing that's held steady for them, and it's really helped their fundamentals, less so the stock, because the stock has been a little bit choppy, but this is total payment volumes over the last several quarters, and right now we're looking at a very healthy almost 417 billion, really wiping away the small sequential decline we saw in the first quarter. Overall, nice growth. Now, one reason, Katie, that folks may be using PayPal and Affirm, these alternative payment companies, a bit here. Take a look at the delinquency numbers that we have here going for at the top here, basically 18 to 40, close to 10% credit card delinquencies, and then between 40 to 60, somewhere between 6 to 7%. So as delinquencies are starting to rise again, maybe we have folks spending using their PayPal and their Affirm and, again, other alternative methods.
Yeah, and PayPal shares currently up about 7-8% right now, so a good morning for them. Abigail Doolittle, thank you so much. Let's keep the conversation going with Margie Patel. She is Senior Portfolio Manager over at Allspring Global Investments. And, of course, we're at a very important point in markets right now. The NASDAQ 100, your big tech benchmark, pretty close to correction territory, that 10% drop from its all-time highs. With that in mind, how high are the stakes for Microsoft, Amazon, Apple this week?
Well, I think that is going to really set the tone, whether we have a mild correction and we pretty much hit the bottom of it, say a 10% correction, and then we have a rebound over the rest of the year. And so I think everyone is really holding their breath to see how these companies roll out this week. We have about 4 very important companies reporting, so that's what's going to set the tone.
How important is AI here, Margie, and how important is it in all of your investments? We've been asking the question repeatedly, how long investors are willing to wait until they get a return on that.
Well, that's right. We've seen a huge amount of investment by the tech companies in artificial intelligence. When will we see the payoff? But I think it's really a long-term positive trend. So I think that we're not going to see a big cutback in expenditures, but we may see a little change in sentiment. So we still think we have several years for high capital investment and very, very rapid growth. So we still think it's very promising.
But how drastic is that change in sentiment? Do you think that more CapEx spending without the proper ROI to show for it would mean that investors are going to start to pull back for a while?
Well, and I think that's what you've seen. I think a lot of those stocks have corrected on the anticipation that we may see less capital expenditures go to them, because we've had the leading tech companies be the biggest investors in technology capital investment. So it's really been a virtuous cycle. So if you break that cycle and any one of these companies cut back on what they're spending because their outlook for the return on AI is less, then you could see more of a correction. But we think that's probably not too likely. We think it's just a modest correction of a sector that's really gotten pretty much overbought this year.
Well, that's a great point, too, that sort of the spillover effect from a bad earnings miss from a Microsoft, for example, it goes beyond just sentiment when you think about the CapEx spend as well. Let's talk about the part of the market that has done well, those smaller companies, the small cap rally. Do you think that's sustainable?
No, I think it's just a really short-term correction as we watch earnings unfold, as we wait to see what the Fed's next move is. And I think it's just really a correction from very, very low relative levels to a modest increase. But we think that the strength in the market is still going to be the large capital stocks, so we don't see any kind of a permanent adjustment to small caps.
Hey Margie, I'm wondering your take on the Fed, because we're getting more and more economic disappointments. The labor market is looking weaker and weaker, and it seems like it could be a mistake to wait until September before they cut, and then only 25 basis points. Do you expect that they could come sooner? Do you think that they should cut further?
Well, personally, I think they should cut at the next meeting, which is coming up obviously very soon. And I hope they won't be, as their historic pattern, too little too late, and recognize that there are lots of signs that the labor market has slowed. And many corporate profits really have slowed down, too. So there are enough signs for the deceleration that they really could act preemptively instead of waiting to see the numbers tell them what happened 3 or 6 months ago, which is how they've been operating. So I'd like to see them act now and be proactive.
But as they do wait, most likely, what do you expect to happen to the consumer as you see the continued weakening through September?
Well, that's right. What you're seeing is lots of signs in labor for consumers, and even on some companies, we've seen, some mixed results being reported and lowered outlook. So that says to me there's a deceleration going on in the economy that is going to continue to go on, a deceleration over the rest of the year. So we really, I think, need the Fed to be more active and step in and lower rates. They've been here for over a year. It's time to move.
Right, yeah, we just passed that 1-year anniversary of reaching the terminal rate.
Yes.
And I know it's not a zero-sum game, but when you think about the scope of this week, we have big data, we have big central bank decisions, big earnings as well. What do you think is going to be the most important factor from here driving the next leg of this cycle?
Well, I think two things. One, I think that what these large cap companies report this week is important because it gives you a good look about the strongest parts of the economy, what they see, how they're going to be investing. And then secondly, of course, what the Fed does here. Will they act or will they wait and watch and see if the economy continues to weaken before they act? So I think those two things.
We obviously we're right around the opening bell, so we focus on equities. We want to talk about single stock stories, Margie, and most of your assets are equities. But for a long time, you managed $10 billion in high yield debt. What can you bring from that experience that helps you construct solid portfolios that are so heavily invested in equities?
Well, I think for one thing, the level of high yield bonds, a double B, say at 6.25%, single B's at 7.5%, defaults under 4%. To me, that's a reflection of the whole economy, and that says the economy is in pretty good shape, albeit decelerating. So the high yield market is not giving any distress signals. There's actually kind of a supply shortage of high yield securities for investors to buy. So we think it's really telegraphing a pretty strong corporate America.
Margie, thank you so much for joining us today. That is Margie Patel of Allspring Global Investments in the midst of a very busy earnings season. Coming up, JetBlue tops estimates for earnings per share as the airline takes drastic measures to cut costs. More on the outlook next. Stick with us. This is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on the stock board right now. We're looking at the S&P 500 up about 0.5%, 12 minutes into the session. The NASDAQ as well. The Russell 2000 gaining back most of what it lost yesterday with an 0.8% gain. Katie?
All right, it's time now for Top Calls. Some of the analyst action in focus this morning. And first up, JP Morgan downgrading Novavax to underweight. The analyst says that the stock price, quote, substantially overvalues its collaboration with Sanofi. Next up, Bank of America raising its rating on Affirm Holdings to a buy. The analyst optimistic that the buy now, pay later company will reach profitability more quickly than the market expects. And finally, JP Morgan cutting its recommendation on Frontier Group to underweight. The firm is growing increasingly uncomfortable with Frontier's dependence on sale leasebacks, Matt.
All right, sticking with airlines, JetBlue shares are rising a lot after earnings beat expectations. The carrier also announcing plans to cut $3 billion in capital spending to boost pre-tax income. It's dropping over 50 unprofitable routes. Let's talk about this with Bloomberg Intelligence senior analyst, airline analyst George Ferguson. So, George, I was saying during the commercial break, last year I talked to a number of JetBlue executives who were basically betting everything on buying Spirit. They didn't get that deal. U.S. regulators put the kibosh on it, and you say they're pretty lucky that they didn't.
Yeah, I think they are lucky they didn't, right? So Spirit would have added a lot more capacity to JetBlue and would have added the wrong capacity, right? It was basic economy kind of a capacity, ultra low-cost carrier kind of capacity. They would have had to re-rack all those airplanes, would have cost them a lot of money. They're in a market right now, again, looks very over-capacitized, I guess if that's a word, has too much capacity. And so I think better not to be paying up for something like that right now. They can manage a much smaller footprint, focus a lot more on premium product, which is the way forward, focus on less expansion. I think that's just better for them right here.
Well, George, that's what I was wondering, the fact that they're going to defer that $3 billion in spending, of course, cutting routes as well. I mean, when does this come back to bite them? It sounds like you're saying that they're far way off from that.
Yeah, I don't think it comes back to bite them near term at all, right? I think the market is, oversupplied. JetBlue's yields were down 4% during the quarter, one of the higher numbers we've seen so far. The markets they're in, East Coast, basic economy kind of stuff, and Latin America are some of the worst performing markets right now, so that they don't need to be adding seats into that marketplace. I think very interestingly too is that if you look at where the airplanes are being cut, they're not being cut much in the next couple of years. They're being cut out 3 and 4 years. So JetBlue look like they're making a bet that there's probably more capacity than the market needs, even multiple years into the future. And taking away some of those that increase, I think, as they just see this market kind of flattish for a while.
And a lot of this renegotiation happened alongside Airbus, which also reports in the next 24 hours. Also reporting is Boeing. When you think of this oversupply problem, George, how does this impact Boeing in the end, along with its own idiosyncratic issues?
Yeah, I mean, the manufacturers have a lot in backlog, right? So they have plenty of airplanes to build. And there are airlines that need airplanes. There's always replacements that you need to put out there, right? JetBlue is more of adding airplanes for expansion. The airlines that need replacements. Boeing and Airbus need to get production up and moving so they can improve profitability. But I think this takes some of the pressure off both of those companies. I think they wouldn't mind some deferrals near term while they're sorting out, their supply chain. But if that persists for a long period of time, if it persists, into next year, I think you'd get into a marketplace that would have a lack of airplanes. We frankly don't see it, and again, I think they probably welcome it and gives them some time to sort out some of the problems in their manufacturing process.
The shares. I mean, even with the gain today, George, they're down 65% over the last 5 years. It's a period that I like to look at because the comp function on the Bloomberg defaults to that. Sonali mentioned in the meeting this morning that this is interesting also, JetBlue, because it's an activist stock, right? Carl Icahn took a 10% stake. Is he driving these changes?
Look, I think that he's definitely going to be an influencer. I think we heard this, with the CEO change that they were going to be looking at shoring up their balance sheet, and they were concerned about excess capacity. But I'm sure he's helping to drive some of the changes.
George, we thank you so very much. Good luck to you. Very busy 24 hours over there for George Ferguson of Bloomberg Intelligence, the senior airline analyst over there. Now, coming up later today, an interview with the CEO of Airbus. That's at 3 p.m. Eastern. Keep an eye on it. And coming up next, we're going to talk about Bill Ackman's IPO fund that may raise 10% of what the hedge fund manager originally anticipated as major investors pull out of the deal. That and more on our Wall Street Beat next. This is Bloomberg.
This is Bloomberg Open Interest. Let's take a look at the stock market right now. About 20 minutes into the trading day, you can see we're higher broadly across the averages. The S&P 500 up about 0.3%. Similar story for the NASDAQ 100. All the action, though, once again in the small caps. The Russell 2000 now up about 0.9%. It was your big loser yesterday, but so far today, Sonali, looks like your big winner.
And Katie, it's time now for the Wall Street Beat. Bill Ackman's planned IPO for a Pershing Square fund is expected to bring in $2 billion. That is less than 1/10 of what Ackman suggested could be raised earlier. Here with more is Bloomberg's Katherine Burton, who reported overnight that one of the large anchor investors here, Baupost, is backing out of the deal. This is $150 million that was supposed to go into the deal, now out. He went from $25 billion for this fund to $4 billion, now to $2 billion. What are the series of events here?
Well, first of all, Bill sent out a letter to his strategic investors, the people that are invested in his company, telling them all these details about who was in, who was out. And that is very unusual. And he eventually had to make that letter public. And the IPO was postponed. And that may be one of the issues why we're seeing the number drop.
It seemed like in the letter that he was saying to wealthy institutional investors and family offices, hey guys, help me big this up now, pre-IPO, because then after the IPO, all the retail money will come in and drive the price up. Is that really the strategy on these things?
That seemed to be what he was saying in the letter, and I think also a little bit of the issue of why they had to make it public.
Does that sting retail investors? Do they eventually learn of that sort of thing and say, hey, I don't want to play this game like that?
Well, it could well be, because most closed-end funds trade at a discount. And so they're doing everything they can in the beginning to drive up the price, but then it could end up trading below the NAV of the fund.
Yeah, and of course, we know that a version of this fund exists already in Europe, and that has absolutely traded at a pretty significant discount. Let's talk about...
But he can't tweet about the European fund, right? And he can tweet about this.
I'm not clear on that one. But
that's what
There's a certain amount of information he can and can't say with the prospectus out, that's for sure. But also another aspect of this, how important was Seth Klarman and Baupost to this deal to begin with?
Well, as you said, it was $150 million, so not really significant when you were looking at $25 billion. Not the biggest investor. There's apparently a family office in there that was willing to buy almost 10% of the deal. That would be the biggest investor. But I think maybe reputationally, Baupost is a big investor, well-known, you know, that could have some impact.
Well, that's where I wanted to go, actually, because who else was named in the letter that we know about? You know, you broke the news about Baupost. Obviously, you mentioned that unnamed family office, but who else could potentially be an investor here?
Well, he also mentioned Putnam as being one of the investors, a big mutual fund company. But clearly, and he said that 3 of the investors that also invest in Pershing were willing to give money. I'm not sure who they are, but clearly he needs more people behind it.
Super interesting also, SoFi is actually one of the underwriters on the deal, just showing just how much retail interest they're trying to get into this IPO. What does this mean for Bill Ackman at large? This is part of a grander plan, isn't it, for him to take Pershing Square, his whole hedge fund, public? We haven't seen a lot of those in history. What does it mean for his reputation at this point in time?
Well, I mean, he's made a huge coup for himself by selling already a 10% stake in the company at a valuation that some people think is pretty rich. So he did that. Now it's going to be harder to go public, obviously, if he has less money under management. And so maybe that's going to have to be pushed off until he gets to be a bigger size.
And I mean, there's also an open question out there about what kind of valuation the hedge fund, if it were to go public, would actually fetch. I mean, there are some examples of publicly...
Sculptor, for example.
So,
yeah, and that was an example of something that ended up not doing so well as a publicly traded company.
That's very true as well. That, I don't know, you think about Elon Musk, he certainly doesn't seem like he likes being the CEO of a public company. And there's plenty of companies, as we've been discussing, that have just been choosing to stay private for longer. So we'll see ultimately if
that's not the point of this, right?
But we'll see ultimately if this hedge fund goes public.
Stay tuned. Supposed to price Monday night.
All right, Kathy, thanks so much for joining us. Bloomberg's Katherine Burton reports on hedge funds for us and this closed-end fund. Let's get to the trading diary, what you need to be watching this week. We get central bank decisions from the Fed, the Bank of Japan, and the Bank of England. Then more big tech earnings roll in with Microsoft and AMD after the bell today, and other notable earnings this week include Boeing, which we talked about, as well as KKR. Coming up in the next hour, SoFi CEO Anthony Noto will join us at 10:30 a.m. Eastern. We'll talk to him as well about, I guess we can ask him about Bill Ackman's fund.
You sure can, why not?
They're underwriting it, as well as a number of other things, including their pivot to a cash lighter business model. And let's take a look at the markets here. We have a lift this morning, just about 0.2% on the S&P 500 and almost unchanged on the NASDAQ. But the Russell 2000, as Katie says, that rotation looks like it may be coming back to life.
Absolutely, and you made the point, of course, it had a big down day yesterday, but already we've almost taken that back. So a lot of volatility in this market. This is Bloomberg.
It is. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, data dependence. We're going to get the latest JOLTS and consumer confidence data as that Fed meeting gets underway.
Microsoft kicks off this week's Mag 7 earnings. The scrutiny is high after Alphabet and Tesla disappointed last week.
And SoFi boosts its 2024 profit forecast for the second time this year. We'll speak with CEO Anthony Noto this hour. Let's get a check on the markets right now, though, because we have a rally underway, of course, ahead of the Fed, ahead of big earnings. You can see the S&P 500 up about 0.3%. Big tech giving back some of its gains right now. The Nasdaq 100 just up about 0.1%. Meanwhile, I take a look at the bond market. It is dead quiet right now. The yield's not really moving in either direction on the 10-year. Currently camped out at about 4.17%, Matt.
All right, let's look for some moves because we just got some pretty interesting economic data. First off, consumer confidence came in better than expected at over 100. The Conference Board's consumer confidence came in at 100.3. We were looking for 99.7. And then JOLTS, the job openings came in higher than expected at more than 8.1 million. In fact, 8.184 million was the number. We were looking for 8 million even. Michael Mckee, Bloomberg's chief international economics and policy correspondent, joins us now. Mike, it doesn't look bad.
It doesn't look bad at all, but there's a couple things you want to look under the hood at here. The JOLTS job openings numbers comes in higher, but the quit rate comes in a little bit lower, which is good news because you want to see fewer people, I'm sorry, I've got it backwards.
So it's bad news because you want to see more people quit, right?
You want to see more people quit. Unchanged at 2.1%. So the bottom line here is that the labor market may be not falling apart. We have had a rise in unemployment, but if there's also a rise in job openings, then they sort of offset each other to a certain extent. Now, these are 2 months old, but it does present a bit of good news to the Fed in that sense. The consumer confidence numbers are interesting. 100.3 from 97.8. That's a revision down, but the present situation numbers come in strong at 133.6. A decline, slight decline from 135.3, and 78.2 for the future, though, which is up from 72.8, a big jump in expectations. And it's interesting because this survey would have captured the drama around the Trump assassination attempt and Biden pulling out. Whereas the Michigan number we got a week ago, that survey finished before some of that happened. So this one might reflect a change in voter attitudes about the overall economy going forward, because not much has happened in the on the economic side up to this point.
All right, Mike Mckee, really appreciate your instant analysis there. And let's keep the conversation going now with Carol Schleif. She is Chief Investment Officer at BMO Family Office. And you take a look at what the market is doing in reaction to this fairly good economic data batch that we just got. The S&P 500 pairing gains, the Nasdaq 100 slipping into negative territory. Are we still in that mode where good news is bad news rather?
I'm not certain you can actually read too much into, especially today and early tomorrow's trading, especially with the Fed getting set to have their press conference after the release tomorrow afternoon. So there's a lot more focus on that in earnings. And so we do expect to see a lot of volatility in here. But the numbers are not necessarily surprising because all the talk a year ago was a recession around every corner, and that's liable to weigh on people's psyches. And so the fact that jobs market has held together pretty well, we're not talking about recession around every corner, and we're just trying to figure out when the Fed's going to start cutting and how big those cuts are going to be. That has people, I think, feeling a bit more optimistic about things. And the fact that, given, as you touched on, all of the things politically that have gone on in the last couple of weeks, people feel like it's not necessarily a one-way sweep on one side or the other, that there's the chance that we can have some gridlocked government, which would allow business and consumers to go on as usual.
You know, I love the point that Michael Mckee was making, that there's more voter reflection in this set of data than you saw in the prior one. And if you think about how important it is for the consumer to hold strong at this point in time, how much fragility is there right now in consumer sentiment, and what kind of fragility does that cause in the market?
I think there is a lot of fragility to consumers in general, because you see it in the quits rate in terms of people are staying put, so they do feel like they need to just sit tight with the current situation. There's probably a bit of optimism that prices aren't rising as much anymore, tinged by a bit of anger and frustration that prices are still much higher than they were than we recall a couple years ago. And you're seeing some pushback. You're seeing commentary already in some of the consumer staples companies that perhaps they're admitting they took the price increases a little too far and they're going to have to toe the line, because consumers are very discerning about what they're trying to do, and it really is about a parsing underneath the hood.
You are investing for a much longer term, Carol. Obviously, at the BMO family office, you're thinking not just quarters, but probably years ahead, right? If you assume that Donald Trump wins in November, does that change at all your portfolio construction compared to, Kamala Harris with a continuation of Biden policies?
We historically have never advised people to reinvest portfolios or adjust portfolios based on what you think an outcome might be. And actually, if you had done that and you look back over the last two presidencies, the common presumption was, for example, that oil stocks would do very well under a Trump presidency and not so well under a Biden presidency, and we saw just the opposite. So building portfolios around politics is not something we advise. We are talking to people about longer-term issues and building durable portfolios that can withstand the volatility. We're focused more on, especially recently, more on we've had a position, a slightly overweight position in small caps, expecting to see that larger rotation go on. And we really do think that markets over the intermediate and longer term revert to focusing on the fundamentals. And that's the glory about what we're seeing this week, next week, is that we're in the middle of earnings season. The fundamentals are front and center, that and Fed policy. So people really can focus on that and not necessarily tweaking things. After the election, we'll see how things sort out. And then there's potential for tweaks industry-wise, depending on how that election turns out. But other than that, we really are trying to build well-diversified portfolios.
All right, so let's bring it back to then a quarterly look and a focus on earnings, Carol. You mentioned the rotation, and we've been, I guess, anticipating a broadening out in terms of earnings. Bloomberg Intelligence has done a lot of work on the Mag 7 and the S&P 493, and concluded that if you take out those mega cap tech companies, we've really been in an earnings recession for over a year and a half. Do you expect coming out of that into earnings growth for the 493 now? And is that why you have confidence in a continuation of this rotation?
We do expect that you'll see some more of that, especially as the Fed starts to cut. And the genie is out of the proverbial bottle as it relates to bringing manufacturing back onshore. Some of the reconstruction projects that are going on, the infrastructure rebuilds that are going on. You saw, the highest municipal bond issuance, if you will, in the first 6 or 7 months this year that we've seen in 10 or 15 years. And that money is just teed up to do those internet build-outs and roads and bridges and things like that. So we do expect that you'll see more participation in a broader variety. But that period of rolling recession, industry by industry, is what impacted a lot of the last year. And you look at certain industries like the housing industry that would greatly benefit from having interest rates come down and getting a resumption of activity there such that people can afford to buy houses and or move or upgrade. There's a lot of different pockets that would really benefit from the Fed cutting, and we do expect to see better business spending and improved outcomes for the 493.
Well, let's talk about what that could mean for the IPO landscape, the M&A landscape, because we have seen some signs of life there, but certainly not a real robust return. Is that higher rates? Is that political uncertainty? What do we need to see to sort of unleash all of that activity?
I think we need to see the Fed start cutting and give us some guidance on how much they'll cut and how long that level goes on. We also need to see people stop talking about the recession around the corner, because that pulled in a lot of business spending and a lot of activity. And it's hard to want to tee up an acquisition or a sale right now if the Fed's going to start cutting in September. So you've seen some of that as we look at it, there's a lot in the pipeline, a lot of talks that have been going on, a lot of things that are teed up that are just waiting for that. And we do expect once you start to see it, one thing you see industry by industry is if there's an acquisition or a takeover in one segment of the industry, all of a sudden everybody's moving and revaluing everybody else in that industry. So we do think once the cork is undone from that bottle that you'll see more activity that way.
Carol, we have to leave it there. That is Carol Schleif of BMO Family Office. Now let's take a look at the stocks moving at this hour. Of course, a lot of earnings underway. Here's Abigail Doolittle. Abby.
Lots of earnings indeed. And let's start off with the shares of Howmet Aerospace. This stock is up the most since May 2nd, really soaring up more than 10%. They beat and boosted. They also hiked their dividend. Truist is calling this quarter of this Boeing supplier stellar. Turning to the shares of F5, the networking communications company also put up a great quarter. Folks are really paying attention to the fact that they raised their full year outlook. The stock up 11%. Many analysts on the street raising their price target. However, the S&P 500, at least the NASDAQ 100, because I can see the chart over here on the other side of the studio, did go down slightly, up now, but in any case, off of the highs for these major indexes. Let's take a look at the main index here, or the main influence, I should say, and that is, of course, NVIDIA over the last 2 days dropping. We took a look at this stock last week, and it is below that key level of 118 as investors really grapple with the idea, has that stock gone too far, too fast at the highs on the year, up 180%, Katie. So this stock now down, you can see here, down 4.3% over the last 2 days, 108. It still looks like it may go sub 100, and we won't be getting these quarterly results until the end of August.
All right, Abigail Doolittle, thank you so much. Now, coming up, Ken Griffin continues to spend millions to back Republican candidates, but to date, he has not donated to Donald Trump. We look into Griffin's conservative priorities next. This is Bloomberg.
Let's get to high interest now. A look at what's making headlines around the world. Protests have erupted in Venezuela as thousands take to the streets of Caracas to protest what they say is President Maduro's fraudulent win. Venezuela's opposition leader claims her party can prove that the incumbent lost by an irreversible margin. The U.S. and many Latin American nations are calling for transparency of the vote tally. A slowdown in Latin America, the Caribbean, and the U.S. pushed Diageo to its first annual sales decline since the pandemic. The British distiller has come under pressure following a profit warning last November. The CEO, Deborah Crew, said that drinkers in Diageo's biggest market, the U.S., have reined in spending on booze. And billionaire financier Ken Griffin is spending tens of millions of dollars to back Republican primary candidates across the U.S., but records show he hasn't contributed to former President Donald Trump's campaign. Since 2015, Griffin's political contributions totaled more than $248 million, $250 million, according to Open Secrets, an independent nonprofit that tracks money in politics.
We're going to get more on billionaire Ken Griffin's political donations with Bill Allison, campaign finance reporter for Bloomberg in Washington. You take a look at the way he's been giving to the Republican Party, and I've got to say, he's been carving out his own voice, hasn't he, Bill? He has been kind of bucking the trend from some of his peers. Where exactly has he been giving, and how does it perhaps dovetail with what, or the lack thereof, with what Trump has to do?
The place where he's been giving money a lot in this cycle, and really started in a large scale in 2022, where we really started seeing it, he's trying to shape the party by giving to candidates running in primary races, and typically open primaries, not necessarily challenging an incumbent. And he has kind of a criterion for candidates. He's looking for people sometimes with business experience, sometimes with a military background. He's looking for people who have strong leadership skills. And he works through a number of super PACs that basically will come in and back these candidates and try to get them into Congress. Now, one of the things that's kind of very different is that we had, especially in 2022, and even to some extent this time, Donald Trump has a certain kind of candidate that he's looking for. Sometimes they're bomb throwers, sometimes they're in the MAGA mold, And that's really not what Ken Griffin is about. He would much rather see people who are elected who are basically going to solve problems and try to steer the country, make Congress an effective place and steer the country.
It seems like he's one of the few people that can avoid, however, the gravitational pull of Trump's control over the Republican Party. Are there any others that give in the amounts that he does who aren't giving to Trump? You know, I mean, how much has he given already in this election cycle? Like $70 million?
Yes, 75 million plus so far. And, we're just, as the saying goes, we're just getting started. There really is not a donor on his scale who does the same things. I mean, there are other folks that have taken kind of similar strategies. Paul Singer of Elliott Management is one who frequently gives to the same super PACs that Griffin gives to. But at the level that he's giving, one of the things is that, I think he was, there are about 7 super PACs, super political action committees that he's giving money to that are playing in these different races. And he was, the top donor in, I think 6 or 7 of them. And somebody pointed out to us, well, he's the top donor because he's Ken Griffin. He gives more than anybody else.
And can we talk about how he's actually giving this money? Because super PACs seem to be the vehicle of choice here, though. But in some cases, he has donated directly to candidates and their campaigns, correct?
Right, exactly. And, he gives to party committees, he gives to candidates, he gives to campaigns. Sometimes he'll give to, there are these vehicles called joint fundraising committees where it's usually like a leader, like a Kevin McCarthy, the former House Speaker, had several. And they'll tack on 30-odd candidates to get money from it, and it allows a donor to write one big check that's then distributed among all these other people. Mm-hmm. And so he'll do that, but he'll also give directly to, and sometimes using the WinRed platform. I'm not sure if it's him making the transaction, but the online donation platform, and he'll give directly to a candidate that he likes.
Bill, we thank you so much for your reporting. Looking forward to seeing more of it into November. That is Bill Allison for Bloomberg News in Washington. Now coming up, SoFi boosting its profit and revenue estimates thanks to its trademark lending operation and its newer tech businesses. We're going to speak to the company's CEO, Anthony Noto, later this hour. Stick with us. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning, and first up, Tesla is releasing a software update to its cars in the U.S. in its efforts to prevent its vehicles' hoods from flying open during driving. Tesla began investigating complaints of unintended hood opening events in China about 4 months ago. For its part, Tesla said it isn't aware of any related crashes, injuries, or deaths because of that defect. Next up, Starbucks investors feeling jittery in advance of the company earnings after the bell today. Now, the coffee chain did unveil new products and launched a campaign to serve its customers faster, but the business is still under pressure thanks to a pullback in demand. It's also facing mounting pressure from activist investor Elliott Investment Management. And finally, Instagram is unveiling AI for influencers. Users will be able to create their own AI-powered chatbots that can answer questions from fans or followers. The tool is part of Meta's AI Studio launch, and the company says that all responses from creator AIs will be clearly labeled. Of course, you can follow all the latest company buzz on TRE and Go on your Bloomberg terminal, Sonali.
Now, one stock, Katie, that we're watching at the open is SoFi. For the second time this year, the fintech company boosted its profit forecast. Its financial services platform and tech platform segments now make up 45% of revenue, up 7% from last year. Here with more is Bloomberg Intelligence analyst Herman. And you take a look at SoFi stock, for example, today, and the open, it was soaring. It was up more than 8%. Right. That has since moderated. What is the cloudiness that people are looking through here in a time where people are really worried about credit quality?
Yeah, so there were some really great positives for SoFi's earnings. Really strong origination activity, positive guidance revisions. Some of the lingering things that really weigh on the stock are how they value their loans with fair value accounting versus accrual accounting for most banks. And also credit quality. They showed pretty stable results, but there is some lingering questions on the pace of charge-offs for most recent vintages that they're originating.
So we don't get with SoFi the typical sort of loan loss provisions that we get from all the other banks that you guys cover.
Correct. So they value their loans on a fair value basis, and I think on their personal loans it's about 104%. So above par, even though rates are elevated. So there's some lingering questions if those valuation marks are correct. The company would point out that they've been continuing to sell these loans to the open market, and those marks are validated by the open market. So that's a positive for them.
And looking ahead, of course, it seems like the whole market is expecting the Fed to cut rates in September.
Right.
How do lower rates interplay with SoFi's business?
Yeah, so one of the main ways that SoFi has been growing is with their deposit product, with SoFi Money. And it's they targeted $2 billion of deposit inflows per quarter, which is very robust. And part of that is rates. They're paying a bit higher rates versus some peers, and they can afford to do that because their loan yields are much higher as well. So their margins are still very healthy. If you do get a pullback in rates, does the influence come in as quickly and as robustly? That could be an open question.
Couldn't it be great for them? If you think about it, if you're getting a 4.6% APY today and rates drop, they lower the rate, but it's still above everyone else's, and they're paying meaningfully less to consumers.
Right. Exactly. So they could still continue to grow. Maybe in a lower rate environment, maybe it's not as robust, but still much better than the industry.
If you were SoFi, what would you charge?
I think they're doing great as they are today, and their margins are very healthy, and they're doing great in really diversifying their businesses. So that's a really great opportunity for them to continue with the SoFi Money product.
If you were talking to the CEO of SoFi, what would you ask?
Right. I would love to ask him a number of questions on their growth trajectory going forward. One of the things they've talked about is diversifying their products. They've been very much more reliant on the lending, personal lending business over the past few years, ever since the pandemic, basically. And they're switching gears, focusing on technology, the investing business, and love to know their long-term views of those trends.
All right. We will ask. For sure.
Sure will.
Herman, thanks very much. Herman Chan there of Bloomberg Intelligence. We're going to continue the conversation on SoFi with the CEO. Next, Anthony Noto joins us, and we'll ask him about a shift in the business model and their long-term growth projections. This is Bloomberg.
All right, we are about an hour into the U.S. trading day, so let's get over to Bloomberg's Abigail Doolittle for an update.
Well, it's a little touch and go right now for markets, Katie. If we take a look at the NASDAQ 100 futures, we can see lots of volatility on the day, and this is really overnight. During the Asian session, you can see futures had been lower and then higher into the open, higher and then down, up, down. All this said, we're looking at small moves right now, down about 0.2%. Nonetheless, that volatility, the idea that there's a bearish reversal in there is not great. Now, for the S&P 500, hanging on to this fractional gain, let's see what happens there. Sealing what is looking like a risk-off picture. Crude oil down 1.2%. Bitcoin sliding for another day, despite former President Trump's big Bitcoin and crypto initiative. Maybe a little bit of a near-term sell the news event. And then we have bonds rallying. So again, a little bit of a risk-off picture here developing. Now, let's take a look at what's happening beneath the surface for both of these indexes, the NASDAQ 100 in particular. So you can see NVIDIA, we looked at this earlier in the hour, down 3.4%. Now in a formal correction, I'm guessing even bear market, from its high below a key technical level of 118, suggesting it maybe go below $100 per share, which we took a look at. And then we have Microsoft and AMD balancing out NVIDIA to some degree. Both of these companies, of course, reporting after the bell. But it's so interesting because we're always talking about NVIDIA with AI, and of course, we'll be learning more about the current demand at the end of August when they report their quarter. Let's take a look at the old NVIDIA driver, and that, of course, was Bitcoin. Bitcoin. What we're looking at here in yellow is NVIDIA, and white is Bitcoin. This is a year-to-date chart, so you can see that for much of the year, Bitcoin and NVIDIA pretty much trading in lockstep. And then when the AI hype really got going, take a look at NVIDIA, almost up 200% earlier this year, Sonali. Bitcoin, you can't see it so well here, but stuck in this range, $70,000, really resistance. The big question is NVIDIA going to drop back down toward Bitcoin so that those trading paths connect? Bitcoin itself looks kind of bearish. It's going to be very interesting the rest of this year. And again, so long as NVIDIA is below 118, it suggests the stock is going to go below 100, maybe significantly so, Sonali.
Abigail, thank you so very much. We're going to switch gears now. FinTech giant SoFi boosting its 2024 profit forecast for the second time this year. The company's CEO, Anthony Noto, having this to say this morning, that despite the rate environment and our conservative stance in lending, we drove sustained strong results in the quarter and are ready to move quickly once things improve. Anthony Noto joins us now. And you look at the results this morning, Anthony, you look at the way you've been diversifying SoFi, tech platform, financial services, things like SoFi Money, really driving SoFi forward here. What does SoFi look like in 5 years from now? How quickly can you diversify this to make that financial services tech business more than half, more than 3/4 really of your platform?
Well, thank you for the question, and also thank you for recognizing the tremendous transformation we've made from being predominantly lending to being financial services products and tech platform. Over the next 5 years, I would expect our growth to result in revenue that's about 30% financial services revenue, 30% tech platform revenue, and 30% lending. The business that's growing the fastest now, and that's increasing as a percent of revenue the fastest, is the financial services segment. We had a record revenue for the quarter at close to $600 million and 22% growth. And it was really driven by that financial services segment that grew 80% year over year and is now starting to reach real scale at about $170 million of revenue. It's benefiting from 58% growth in AUM in our invest business. It's benefiting from deposit growth of 80%, and it's benefiting from high interchange revenue growth as well, and of course 40% product growth in that segment. So that'll be the horse that we continue to ride to drive the diversification. Mm-hmm. The second element would be, as you mentioned, the technology platform business, which we believe is a mid to high teens grower for the rest of this year, for the full year, I mean, and then going to 20% growth next year as we have a great backlog of partners coming online, hopefully in 2025.
Anthony, one major question is around interest rates. If you do see the Fed cut this year, then what does that 4.6% APY on your SoFi Money product look like moving forward? If it lowers, how competitive do you have to be to keep that money flowing in?
Yeah, we think we'll still have a very competitive APY in a declining rate environment. Several of our businesses will benefit meaningfully from a lower rate environment. The loans in our balance sheet will be worth more, everything else equal. Home loans will actually see more refinancing, and that business should benefit for greater demand, greater marketing efficiencies, greater flow through. Also, our student loan financing business would benefit. That will all allow us to continue to maintain a very high APY relative to competition. Many of our competitors that offer an APY that's even close to ours, we're at 4.6% if you do direct deposit. We're still superior to others, but those that are close to us will struggle to keep the same rate and the same premium because they're not origination platforms. So we benefit from both those businesses working well together.
What do you think, Anthony, Wall Street isn't seeing that you do in terms of your potential? Because the shares, they're off a little bit today, and I guess it really doesn't matter what happens on one day. But since the IPO, they're down 30%.
Yeah, I'd say the biggest thing that's not being recognized is the tremendous scale that we've achieved in our financial services segment and the growth that it's contributing. The fact that we hit record revenue and 22% year-over-year revenue growth in our lending business, the original business that was 99% of the business when I joined in 2018, only grew 5%. We were able to grow 22% year-over-year with a record revenue, and the oldest business we have only grew 5%. That is a fact that's hard to deny, and one that really exemplifies our transition to being a less risky, less capital-intensive revenue business, and we just have to keep executing on that. I do think over the coming days and weeks, as there's more clarity on rates from the Fed, more clarity on lending performance, et cetera, it will start to be recognized. We actually saw a decline in our delinquencies for personal loans for the first time since they started going up after the pandemic. And that's an important inflection point that people should also start to recognize.
I want to talk about the contours and the makeup of the business going forward, because you talk about this diversification. It seems like investors certainly like that, that less emphasis on personal lending in particular. I mean, looking forward, where do you see personal lending falling in terms of how big of a business it is for SoFi?
Yeah, that business, the volume we did in personal loans in the quarter was up 12%. As I mentioned, all of lending revenue only grew 5%. Student loan refinancing and home loans actually had great quarters. Home loans had 71% growth year over year, and student loans 86% growth year over year. So the personal loan piece will probably stay pretty consistent with the guidance that we've given. The other two businesses in lending could do better if we continue to see an improvement in the economy and rates coming down. But their overall lending business is going to drop to about 50% of our revenue, and non-lending be 50% by the end of the year. Today, it's about 57% of our revenue lending is.
Anthony, I think it's pretty fair to say here that investors are kind of concerned about credit quality at this part in the cycle. How do you kind of categorize the cleanup work you've had to do in your portfolio to get to the place where you're comfortable with the go-forward loans you're extending?
Yeah, we haven't had to do a lot of cleanup work. We've had to stick to very tight credit standards. We did tighten our credit box late last year. We're seeing the benefits of that now. As we mentioned on our call, our delinquencies, which are a leading indicator of losses, hit a peak in March and have come down in the quarter sequentially on an absolute dollar basis, as well as percent of revenue. So that's an important inflection point. The second thing we provided information on was vintage analysis. And you look at our total portfolio of loans, how much of the unpaid principal balance remains, and what's been lost to date, and then what could be lost in the future. And that vintage analysis shows very clearly that we're likely to be well within our tolerance level of a lifelong loss of 7-8% for our loans over their lifespan. So it was an important additional disclosure that we've made, and I would point investors to that, as well as the trends in delinquencies.
The area that you're in is a hot one right now. Gen Z and millennials are, I think, very interested in finance and taking care of their finances responsibly. How much is it to acquire those kind of customers? I mean, they have now so many other choices with, I just came from Europe, so N26 and Revolut, but also Marcus and SoFi. How much do you spend for each customer?
Yeah, every product is different. We're GAAP profitable. This was our third quarter of GAAP profitability. Our EBITDA, or a good proxy for cash flow, EBITDA less CapEx, has continued to grow very nicely. It was up 80% year over year to $137 million. A big reason why we're seeing such improvement in profitability while seeing such growth in members at over 40%, products at over 40% growth, and revenue at 22% is marketing efficiencies. Chris LaPointe, our CFO, mentioned on the call that marketing as percent of revenue improved by about 7 basis points on a year-over-year basis. 40% of our product growth is from existing members, which means we don't pay a second customer acquisition cost. It's a huge competitive advantage to get that second and third product at no customer acquisition cost. Gives you great leverage. For us to be successful, to become a top 10 financial institution, which is our goal, we have to become a household brand name. And we measure our success in that area based on unaided brand awareness. And we've achieved about 7 to 9% unaided brand awareness in the most recent period, which is up 4x from where it was back in 2021. So we're making great progress.
Anthony.
Our marketing team is hitting the ball out of the park as it relates to our ability to build that brand awareness and drive adoption.
Speaking of marketing, there is another deal in the market right now. That is the Pershing Square USA closed-end IPO fund, and you are one of the partners on the deal here. How important is it to you to be on this deal, particularly because of the retail interest involved? What does this look like for you?
Sure. Our SoFi Invest strategy overall is to give Main Street investors access to what high net wealth and hedge funds and institutional investors get access to. So when we launched SoFi Invest, we actually launched with stocks without commissions. We pioneered fractional shares. We launched with a number of ETFs that allow people to diversify their investment, do dollar cost averaging at low price points. We have robo accounts. In addition to that, we have alternative asset classes. You can now buy private credit, private real estate, and venture capital at SoFi In addition to that, IPOs. And so we're offering IPOs at the IPO price to Main Street investors. I can't talk about any particular IPO, but IPOs are a part of our overall selection, differentiation in Invest. In addition to that, we're ready to roll out a directed share program for those issuers that want to provide IPO access to their employees and their partners. They can do it in a turnkey way with SoFi in the most scalable directed share program that I've ever seen in my professional career. Someone can sign up, make a deposit, and put an order with no minimum balance and no fees.
It's been an amazing professional career. Since you graduated from West Point, you've had a huge breadth of experience on Wall Street and in business. You've been working with SoFi or social finance throughout the last couple of terms. And I want to ask you for, all the CEOs who watch Bloomberg and don't have the experience that you do. We could get back to a Trump administration after November, or we could have, Kamala Harris, which in some ways would be an extension of the Biden administration. What has been different about those two operating environments that you can share with us?
Sure. Thank you for the question. So we've operated under both types of administration, Republican and Democrat, since I joined the company in 2018. The fact of the matter is we're building a durable business that is based on achieving financial independence for our members by being a one-stop shop for all the major decisions they make in their lives and all the days in between. And that's a lifetime relationship. So the reality is we're going to operate in, whether it's Republicans or Democrats, in a great way. On the margin, are there more benefits to capitalism, to M&A, to market activity with a Republican versus Democratic administration? Historically, there has been a lot more capital markets activity, M&A, et cetera, with a Republican versus Democratic administration. But there's also stronger social programs with Democratic administrations, which SoFi can uniquely help with, given our financial education, our Community Reinvestment Act capabilities, et cetera. So we can operate in either environment. There are pros and cons for each. Generally, I'd say with Republicans, a lot more M&A activity, a lot more market activity, and with Democrats, a lot more social activity, both of which we can play in.
All right, Anthony, thanks so much for joining us for this interview, and thank you for your service as well. Anthony Noto there of SoFi. A quick check at some of the other notable earnings movers this hour, because there are some big ones. Sprouts soars to a record. At one point, it was up over 20%. The natural and organic food retailer boosted its full-year projections for comparable sales and profit. PayPal rallying the most since November of 2022 after lifting its forecasts for 2024 profits. At one point, it was up more than 10%, and JetBlue is still up more than 20%. You can see the gain here, 21.25, as the airline implements a sweeping plan by its new CEO to restructure operations and return to profitability. A lot going on in this market today.
At least two of those funds, for the stocks, have activist funds in them. Just saying.
Yeah, no, it's a very good point, and I think a very interesting point as well. We'll talk more about that on the other side of this break. This is Bloomberg.
Well, Wall Street Week is in Colorado for the annual meeting of the Aspen Economic Strategy Group. David Weston is on the ground, and he caught up with economist Melissa Kearney.
Well, what we did last year was we looked at a whole bunch of different elements of what we thought it would take to build resilience in the U.S. We're not done, right? we could still keep building resilience, but I think we started and we pushed forward really important conversations. So, for instance, one issue we took up was building more fiscal resilience. Of course, this is still an ongoing challenge addressing U.S. debt, but we had a proposal last year written by Mark Duggan about smart reforms for Social Security, and I think that got a lot of interest from people across the political spectrum. It was, just evidence-based ideas about how to reform Social Security.
There are questions about what we ought to do, whether it's industrial policy, trade policy. There are prior questions about if we do it, what will be the effect? And one of the things I think you look a lot at is whatever you want to decide to do, what is the effect of actually imposing tariffs on trade, for example?
Right, that's exactly right. So let's take as given that policymakers, politicians, Trump wants to bring jobs back, wants to, produce things domestically. Imposing tariffs, we can look at the evidence, that's likely to drive up prices, and it's not likely to create jobs. So once we actually take the evidence, it becomes harder to just put forward talking points or policy proposals. And so then we say, okay, well, if we really do want to produce more imperative products in the U.S., if we really want to build up jobs in distressed areas, what does the evidence tell us works? And so a lot of what we're trying to do is bring evidence to bear, not just allow talking points to be repeated, but actually to say, let's challenge ourselves to come up with policies that will achieve the objectives.
So you are responsible for organizing and putting together this entire program, but you're also on a panel yourself on higher education. And certainly it's been an issue for a while, but certainly over this last year, higher education has been right on the front page every day. A lot of questions about what higher education is, what it should be, what it's doing. What's your view on how bad the situation is right now for higher ed?
Let me start by saying I'm bullish on higher education. American universities are the greatest in the world. Our higher education sector is crucial to building up skills, to creating and producing basic scientific advances that improve living standards. But I think that the challenges facing higher education are real. I think the loss of confidence in higher education, in the value of a four-year degree, that many Americans express, that some red state governors in particular are pushing back on, I think those sentiments provide a challenge that leaders in the higher education sector can't ignore. The optimist in me thinks that this reckoning is perhaps a really good thing, and that it's time for college and university leaders to think about, what is our purpose? What are we doing here? Have we become so bloated that maybe we've lost some of the focus on teaching and research excellence? Have we driven up costs in a way that people are right to start questioning whether the college experience is worth the cost? And so we're going to be unpacking this in the discussion in our group, and we have a lot of people in the group who are college presidents, former college presidents, involved in colleges in a variety of ways. And so I'm really looking forward to this conversation about what needs to happen on campuses, what kinds of cost containment measures need to be implemented, what kinds of things need to happen to reverse some of the ideological conformity on campuses in a way that we could restore the public's trust, restore the value proposition of a college degree, and make sure that the erosion in public sentiment, support for public funding doesn't continue.
Is there a discussion going on about what the central mission of higher education is? Because you just mentioned two things. One is educating people, getting them ready. Another is ideology. And there's been a lot of discussion about ideology on college campuses. I mean, all people have ideologies. There's nothing wrong with that. Right. But it seems to have really come to the fore on college campuses in a way I haven't seen before.
David, I think this is a really interesting question. And as someone who spends most of my time on a college campus, it strikes me that when you read the mission statements and strategic visions of colleges these days, they use very sweeping language. Most of them are in the service of humanity. They're radically committed to equity, diversity, and inclusion. I think it actually, all of the verbiage is great, but it does make me wonder whether some focus has been lost. And so, again, this is a watershed moment for four-year institutions in particular, and I think getting back and forcing these colleges and universities to ask, what is our main purpose, is really important and ultimately could be very beneficial.
You just said forcing them. Who's going to force them? Nobody likes a boss, and that seems to be true with higher education as well. There's tenure, there's presidents, and what is the mechanism to hold them accountable?
Well, we've got enrollment declines that are going to continue. Demographic changes are actually going to continue to see, I think we'll see declines in enrollment. So that's going to force colleges to figure out, to re-examine their business model and what they're offering. If public support erodes, public universities in particular are facing a backlash, and they rely on taxpayer money for a lot of their, to keep their business model going. And so those will be forcing mechanisms.
And that was Melissa Kearney, director of the Aspen Economic Strategy Group, speaking with Wall Street Week host David Weston. This is Bloomberg. Well, let's get a quick check on these markets right now. A reversal underway. The S&P 500 actually a little bit lower. Big tech taking a bath here, down about 0.4%, reversing those earlier losses. Still, Sonali, the bond market pretty quiet.
Bond market pretty quiet, and of course we have that big FOMC meeting tomorrow, of course the press conference, and tomorrow before that we have an exclusive interview with Howard Lutnick, Cantor Fitzgerald Chairman and CEO. This is Bloomberg.